Solutions. We at Centroid Solutions focus on risk management. We have several products. We have a risk management solution that aggregates information from multiple trading platforms, multiple servers, and basically quantifies and analyzes risk on real-time basis. We've also developed a sophisticated bridge that deals with the hybrid model using quant methodology, which I will be exploring further during the presentation. And we also have developed a simulation engine, like a backtesting engine, which will allow retail brokers to kind of backtest their hybrid model before implementing. We also have regulatory reporting solutions to automate mainly EMIR and MIFIR, and we've just announced the launch of our own aggregator. So to start, as you all know, existing brokers and existing technologies, most of them, if not all of them, deal with the hybrid model at the client level or the instrument level. So basically, the risk officer typically performs his risk analytics separately away from the trading platform, whether using Excel, standalone systems, and based on the outcome, decides whether a client should be A-booked or an instrument should be A-booked, whether fully or partially. For us, we don't believe from a pure risk perspective that a risky client is necessarily risky at all time. Risky clients sometimes give the broker healthy flow. It really depends how the trade blend within the trading book of the broker at the time of the initiation. So the system basically tracks a lot of data and allows the broker to run his hybrid model at the trade level. As you all know, in the institutional world, like when a bank facing a financial institution or another bank, they will never basically say that they're better informed than their counterparties. They're all equally informed parties, and they deal with the risk management at the trade level because this is where the risk lies. Historically, in the retail space, based on the fact that most of retail traders, they end up losing money, so the more the strategy is basically separating good apples from bad apples. But recently, there is a lot of development when it comes to algo trading. We're seeing a lot of sophisticated strategies being used by retail traders, whether on optimizing their signal, entry-exit signals, or even doing better money management. And we believe that we're going to see a lot more of that going forward. And this is where it becomes very important to run the hybrid model at the trade level. So I'll give you an example here. So basically, in this example, it's, as I told you, we track a lot of factors that relates to the client statistics, the portfolio-related factors, whether the exposure and the underlying currency, the instrument, all the trading stats that relates to the client. And he can do different blends relating to different factors. So I'll give you here an example. So basically, it's an OR case going from left to right and an AND case going from top to bottom. So here in this example, assume a broker feels that a trade coming, an algo trade, coming from an expert advisor or via fix, coming from a client that has an average holding period less than 120 seconds, so he's high frequency and he's using automated trade, he believes if these two conditions are met at the time of the trade, he needs to STP that trade. So he ticks those two, and all the way at the bottom, he say, if these are true, STP 100%. Then let's say he will design another filter where he doesn't want to take with a single client more than 50 contracts, but also not only he doesn't want to take more than 50 if the client has a profit factor over 2, which is a ratio of profitability. So if these two conditions are met and the client has an unrealized over positive unrealized because the profit factor takes the closes only, so he want to make sure that he's not running a loss on his open positions. So if these three conditions are met, he want to STP 50%. Then he designed a third blend. Let's say a broker doesn't want to hold more than 100 contracts in a single instrument, but he's willing to take extra exposure provided that he's building that exposure in increments of 2 contracts. So he ticks, if I'm holding more than 100 contracts of any given instrument, I don't want to add more than 2 per trade. So if he's hit with like a 5 contracts, 5 lots trade, he's saying I want to STP volume over 2. So 2 will be B-booked and 3 will be STP'd. And so on and so forth. He can design as many as he wants, and these analytics and this quant methodology will be pushed to the bridge, and it will automatically route between the A and B book without having to make the calls or do the analytics separately away from the trading platform. Running that is is tricky because we all know that nobody have done it before yet, because running the hybrid model at the trade level may put the broker in conflict with the client, meaning in the opposite direction of the client, or over-hedging the client. And I'll give you an example about that. So assume a client, assume you have one filter saying that you want to STP anything if you have any volume over 100 contracts. And at the time you were having over 100 and the client hit you with, let's say, sorry, I need to explain on that. I move to the next slide. So here basically you can do much more on the filters. You can basically tackle the concentration risk, meaning you can say that you don't want to hold with a client more than 10% of your overall longs or overall short, but you don't want to flag something as a concentration if he's holding, let's say, one contract. Like if you have an unpopular instrument and you have only 2 contracts exposure and someone is holding one, he's 50%, but this is not a big risk. So you can set these 2 filters, and if it's true, it will be STP'd. You can set a filters to maximize your internalization as well. Let's say you don't want to hold more than 100 contracts, but you want to STP any short trades if you have long. So you allow for internalization more and more. When it comes to basically doing it, the previous thing that I told you about how to running it at the trade level may put you at conflict. So assume you have one filter which is 100 contracts, and the client hit you with a trade of 5 contracts, and you already have 100, so it went to the A book. So the client has an exposure of 5 contracts, and it was STP'd. Then let's say in time 2, the client initiated another trade. And at the time of that second trade, your exposure went to 80, so it didn't meet any filters, so it went to the B book. So the client has 10 contracts, 5 of which were STP'd relating to the first trade. Let's say half an hour later, the client decided to fully hedge. So he initiated 10 contracts short. So the client doesn't have any positions while you still have 5 contracts relating to the first trade. So the execution engine will track the positions per client, per books on his A book and on his exposure as a whole, and it will recognize that and closes those 5 contracts. And there are over 15 execution scenarios that may put the broker in conflict, meaning over hedging or in the opposite direction. Like partial fill, some clients, they hedge and flip as well, partial hedge. So there are over 15 scenarios that needs to be tackled from an execution perspective to avoid this mismatch that may occur if you run the hybrid model at the trade level. So then we move to how you would optimize your hybrid model through backtesting. So we've built the technology based on big data and tech data market prices that will allow the broker, based on the filters that he decided to run, to backtest his model. But before optimizing that B-book model, it's very important to understand the split of your P&L on your B-book. A lot of the brokers, they don't track that. So let's say the client, the broker took a B-book trade. And the client initiated a trade of euro-dollar of one contract at price 1.2220. And it was a B-book trade. Assume the market went against the client by 10 pips, so the client would lose $100 and the broker will make $100 on his B-book. And assume the spread between the bid and ask at the time of the trade was 2 pips. So basically, the spread revenue on your B-book is $20 out of this 100, and 80 we call it principal, which relates to market movement. And it's very important to track how much you're making in spreads and commissions and swaps compared to the principal revenue, which relates to the market movement. And once you track that, you'll be able to basically optimize your hybrid model. So once this is clear, then if a broker has, let's say, 3 years of historical data, and he believes, the risk officer, that these are the 10 blends of risks or factors that he needs to track, and based off them, he needs to run his hybrid model. We will take his historical data, we will put them in the engine, we run them on time series, and we basically track what were these factors in the history, and we route those trades between the A and B book. And the outcome basically is to show him a comparison between 100% B book model, assuming the broker did not send anything to the market, 100% STP model, assuming he's sent everything to the market, and the hybrid model that he's intending to run, and which is basically a split between A and B book. So if you look here in this example, this is a 100% B book model. the system automatically separates on a per month basis how much he would have generated in spreads, commission swaps, and in principal, and the total 100% B-book model. And as you can see here, that 57 million were generated in spreads and commissions and swaps, and only 18 million in principal. A lot of the brokers that they run a B-book model, they are under the impression that they're making their money out of the losses, while the bulk of the money is really from spreads and commissions and swaps. Over 2/3 on average, every broker revenue on his B-book is coming from spreads and commissions and swaps. So he's internalizing mainly to capture the full spread and commissions in reality. Then we will show him what would have been his results, assume he STP'd everything. So to be able to calculate that, we need an assumption from him how much he's paying for bridge processing fee, how much his LP is charging him, whether $5 per million, $8 per million. And we will show him his P&L net of hedging cost. So how much he would make on his A-book net of all the hedging costs. So here in this example, running a hybrid model, running a 100% B-book model, he would have generated 78 million. If he would have STP'd everything, he would have generated 35 million. So obviously leaving a lot of money on the table. The hybrid model, which is basically a split between the A-book and the B-book, and based on the filters that he wanted to use, and you can see here that he would have generated basically how much he would have generated on his A-book and on B-book, split again between spreads and commissions and the A-book net of hedging cost. Then you will move to the comparison. And this is important here to look at. Based on the filters, the broker, he would have STP 32%. So you can see the 100% B-book model over those 5 years of history, he would have generated 78, assuming he warehoused all the risk. The hybrid model, he would have generated almost 70 million. Although he STP'd 32%, but he did not lose 32% of his revenue. He lost only 8%. And this is the edge of running it at the trade level, because a 100% B-book model is basically assuming you warehouse all the trade is really a result of positive and negative trades. So assume a broker generates 10 million wearing all the risk. This 10 million is a result of 20 million positive trades and 10 million negative trades. So theoretically or hypothetically, if you be able to detect every losing trade for you as a broker and send it to the market, the alpha you can make 20 million, which is impossible to detect every losing trade, but this is where the alpha for R&D. And this is where you see that you're STPing 32% while still giving away only 8 or 9% of your 100% B-book model. And depending on the flow that you're running, you can further optimize. Then we will show the broker. Basically, we will compare each model using risk-adjusted return ratio that are widely used in asset management. You can see the volatility of each model. Then you can see how much you've generated in CAR, in return, in each model. Then you can see here, let's say, the maximum drawdown, which is peak to valley on the money that you're running on the portfolio. You can see that on the hybrid model from 100% B-book model, your drawdown went to half. Then you look at basically the Sortino ratio, which is the return divided by the downside volatility, and you can see that it doubled. Also, you can see on the Sharpe ratio, it has improved. On the Kalmar ratio, which is your return on your drawdown, also doubled. You can see that the number of positive months have improved from 80 to 87. And you're still being able to capture the best month. The best month was 26 and you captured 30, and the worst month is half of the worst month in running a 100% B-book model. And this is where the optimization of the book, where you can basically capture the upside and as well protect the downside. And it's all about really risk-adjusted return, because at the end, we're all in trading. That's it basically, and thank you very much for attending. If you have any questions, I'm more than happy to answer them later. Thank you very much.